This video is for everybody. Hey, what's up YouTube? This is Foxtel Digital coming to you again with Black Girl Stocks. And in this video, we're going to be getting into the sauce behind successful trading and breaking down 4 main categories of trading indicators. This video is really going to give you an in-depth understanding of why you're using each one of these particular indicators on your charts. No single indicator is foolproof 100% of the time, so it's always important to use a combination of indicators to confirm your analysis and those signals. This video is packed with valuable information, so it might be a little bit lengthy. I'm gonna have the timestamps below in the description so that you can literally just go and click to whatever section that you want to see. But before we get into it, let's go over what each of these indicator categories are, and then some tips on the best ways to use the top indicators in each class. What are trading indicators really? At the most basic level. So trading indicators are tools that you can use to analyze the market and make decisions about when to enter or close trades. You can use indicators to highlight and identify trends and other key factors that affect the price of an asset. And so when I say asset, that goes for anything. That could be stocks, options, Forex, and even crypto. For the remainder of this video, whenever I'm talking about a stock, option chart, anything that involves charts, I'm gonna use the word asset. The 4 types of trading indicators are trend indicators, momentum indicators, volume indicators, and volatility indicators. A trend following indicator is gonna help you determine whether a market is trending up or down. A momentum indicator is gonna help you identify when a market has reached its peak or bottom and is starting to reverse. Volume indicators help you identify when there's an increase in buying or selling pressure in a certain time frame. And lastly, volatility indicators are going to help you identify how much the price of an asset has moved or fluctuated over a given period of time. And volatility is usually measured in 30-day periods. Let's break down each one of these indicator categories and also take a look at some of the most popular tools in each one of them. Trend indicators. Trend following indicators are the most commonly used indicator in trading. Now, these indicators are used to identify the direction of the market trend, hence the name. They're gonna tell you whether the price is moving up or down and also how fast it's moving by using the slope of the trend. Hello, algebra. So if you're looking for an early indication of a trend, using one of these indicators is gonna help. Moving averages, Bollinger Bands, the Directional Moving Index or the DMI, Commodity Channel Index or CCI, the Parabolic SAR. Moving averages are calculated by averaging the closing prices of an asset over a specific period of time. So we can look at different time frames like 10, 20, 50-day, 100-day for short or long-term trades. So let's look at an example using the moving averages. The stock will look at Facebook and the time frame is on the daily chart. To gauge the speed of a trend with moving averages, that's when you're going to consider the slope or angle of the line. So when you see a steep slope, then that's going to indicate a trend that's moving quickly and gaining momentum, suggesting a stronger trend. On the opposite, if you see a flat slope, then that shows a slower paced trend, indicating that it's weaker. So you want to be cautious in these type of market conditions or trade neutral strategies. Using the moving averages, if the price crosses above the moving average, then that suggests a potential uptrend, a buying opportunity. On the opposite, if the price crosses below the moving average, then it may signal a possible downtrend and a selling or shorting opportunity. Now, if you're using moving averages for trend reversals, set up 2 moving averages on a chart, one that's short term and one that's long term. So that could be 50-day and a 200-day moving average. If the short term moving average crosses above the long term moving average, also known as a golden cross, then that's considered a buying opportunity. On the opposite, if the short-term moving average crosses below that long-term moving average, also known as a death cross, then consider selling or taking shorting positions. Bollinger Bands are a trend following indicator that use price action to determine the direction of the trend and also highlight potential reversal points. Bollinger Bands can determine if the price is high or low compared to its moving average. It's made of 3 lines. The middle band is a moving average and the upper and lower bands represent 2 standard deviations away from that middle band, and they they represent volatility. Think about it like a rubber band that stretches and contracts based on the market conditions. So the relationship between the price and the bands is one of the most important aspects of the Bollinger Band. As a trend following indicator, traders usually look for price moves that break outside of these bands. So if you see the price break above the upper band, then that shows a potential uptrend. And then on the opposite, if you see the price break below the lower band, then that indicates a potential downtrend. And you can use these breakouts from the bands as signals to enter or exit trades in the direction of that trend. Now, when the price tends to stay in between those bands, then that suggests a stable and persistent trend. And so you could use this as buy or sell signals also. So when the price trend moves up to that upper band, that could suggest a potential reversal or a possible continuation. So that's something to look at. But let's just say examples using these bands. And we're going to say the stock is going to be Alphabet or Google, and the time frame is going to be on the 4-hour chart. So when the price touches that lower band, then that can suggest that the stock is oversold and a potential buy opportunity to profit from an expected uptrend. When the price touches that upper band but doesn't break out, then that could suggest that the stock is overbought, and that could be a potential sell, expecting it to move downward. The last trend following indicator is the Ichimoku cloud. Ichimoku cloud is a trend following indicator because it uses multiple lines to analyze the market and determine the direction of the trends. Honestly, it's kind of like having several tools in one indicator. So let's look at an example trade using the Ichimoku cloud. The stock is going to be Amazon, AMZN. The time frame is going to be on the daily. One of the main components of the Ichimoku cloud is going to be the Kumo, or the cloud itself. And you'll see these large either green or red clouds. One way to look at it is when the price is moving above the cloud, then we're going to consider that a bullish signal indicating an uptrend. On the other hand, if the price is moving below the cloud, then that suggests a bearish signal indicating a downtrend. So it really helps us to identify the previous trend in the market. And honestly, it kind of gives you a look at the potential future. So I really love the Ichimoku cloud. Another line that we look at is called the Chikou span, which represents the closing prices of an asset plotted over several periods back on the chart. If the Chikou span is above the price, then that confirms a bullish trend. But on the opposite, if the Chikou span is below the price, then that confirms that bearish trend. By using all of these different lines together, we can gauge the overall market trend and find potential reversal points. So it's a really good tool at helping you know decisions about when to buy or sell a position. Let's look at momentum indicators. The most popular way to measure the strength of the trend is to use momentum indicators. These indicators are used to capture changes in the trend direction earlier than other indicators. So these are more forward thinking. And this is because they measure the rate of change in prices. And this can help identify when the trend is either picking up or losing momentum. Momentum indicators are also known as oscillators. To use momentum indicators, you're going to want to look for overbought and oversold levels. You're also going to want to look for divergences between the price movement and the movement of the indicators. Okay, so I know you guys have heard the term divergence. When we say divergence, if the momentum indicator is moving in one direction and the price is moving in another direction, then that could indicate that the price movement is about to change. Some of the most commonly used momentum indicators are the relative strength index, okay, the RSI, the MACD, okay, moving average convergence divergence, the rate of change, and the ADX DMI indicator. I actually go over that in full detail in this video, so make sure you watch that video on the ADX and the DMI. Now you have the relative strength index, okay, the RSI, the most popular. The relative strength index is a momentum oscillator that measures the speed and change of price. This is going to be valuable for you if you're looking to identify potential trend reversals or continuation in the current trend. The RSI indicator moves in between 0 and 100. If you see readings above 70, those are going to be considered overbought conditions, also known as potential sell or bearish opportunity. And on the opposite, if you see a reading below 30, then that usually indicates oversold conditions and a potential buy opportunity, but you have to wait. If you're in a long-term uptrend or a long-term downtrend, you're going to want to tailor the RSI limits. The 70 and the 30, it's not going to be the same in a downtrend. Open this video on a new link and check out that information. So let's just look at an example trade using the RSI indicators. The stock is going to be NVIDIA Corporation, and the time frame is going to be 4 4 hour. To use the RSI indicator for a trend continuation, in that scenario, you're gonna wanna identify the current trend and then look at the RSI levels. So if you're in an uptrend and you're looking for a continuation, look for the RSI to stay above 70. Now that's going to signal that the stock is overbought, but at the same time, more than likely going to continue because the RSI can stay overbought and oversold for a while. If you're using the RSI indicator to look for trend reversals, then that's when you're going to want to first identify the established trend and look for divergences, okay, differences. So a bullish divergence is going to happen when the price is making lower lows, but the indicator is making higher lows. So in this situation, the RSI, it has a peak low, but that low is increasing, and at the same time the stock has lower lows, so they're moving opposite. So that price is moving down, but that RSI is moving up, so that's suggesting a potential uptrend reversal. Now a bearish divergence, on the other hand, that happens when the price is making a higher high, but the indicator is making a lower high, so the RSI is making lower peaks, opposite direction. So that's indicating a potential downtrend reversal. So of course confirm with other indicators like volume, trend lines. And just as an update, so when we filmed this around October the 20th, Nvidia was trading around $434. Today it is $413. The downtrend did take pursuit. Back to the video. Let's look at the moving average convergence divergence, or more popularly known as the MACD indicator. The MACD is considered to be a momentum indicator because it measures the relationship between two exponential moving averages. Okay, so that's going to be the MACD line and the signal line, and you can color that whatever you want. So you're going to have a short term and a long term of that asset's price. The MACD indicator is going to give you an insight into the strength and direction of the price momentum. And by doing that, that's going to help you find potential trend reversals and also shift in momentum. Let's look at an example trade using the MACD indicator. How can you find an asset's momentum using the MACD indicator? When the MACD line crosses above the signal line, that is a bullish buying signal, indicating upward momentum. Now on the opposite, when the MACD line crosses below that signal line, then that is a bearish signal, indicating downward momentum. Now remember those divergences. Divergences are going to be a great way to see trend reversals in the price movement. A bullish divergence is going to happen here, similar with the RSI, when the price is making a lower low, but that MACD line is making higher lows, then this suggests a potential upward momentum. On the opposite, a bearish divergence is going to happen when the price is making higher highs, but that indicator, that MACD line, is making lower highs. So that's indicating a potential downward reversal. Now let's move on to another one. Now the rate of change indicator, that's going to measure how fast prices are rising or falling. This indicator is going to help you spot sudden changes in the price. When the ROC value is positive, we're talking upward movement. Happy dance. If the ROC value is negative, then we're going to be looking at downward momentum. The size of the ROC value, that's important because that's going to indicate how strong the momentum is. It doesn't matter if it's positive or negative, but the bigger the positive or negative value, the stronger the momentum. So whether it's bullish or bearish, size matters here with the rock. Let's go to the volatility indicators. Volatility indicators are going to be used to measure the potential for large market swings, either up or down. So you can think of volatility indicators like a weather forecast for the market, how risky it is, and also what kind of trend may be developing. These indicators can detect when market conditions are becoming range bound. Depending on your particular trading style, volatility indicators can help guide you in different ways. Okay, so for example, if you're a short-term day trader or you scalp trade, then you could definitely get into some very volatile markets and make quick, large profits. But on the opposite, if you prefer more long-term trades, then you may want to stick with less volatile markets. So some popular volatility indicators are going to be the average true range, Bollinger Bands, which we already talked about earlier. The Bollinger Bands expand, volatility is increasing. When the Bollinger Bands The Chaikin volatility indicator. Out of all of these, the ATR is pretty much going to be the rock star out of this group of volatility indicators. So when we're using volatility indicators, keep an eye out for large increases or decreases in volatility. So those are going to be the telltale signs of potential trend reversals. Let's look at the average true range, ATR. Now, the average true range measures price gaps over a specific number of trading days to find the market's volatility. So let's look at an example trade using the average true range. The stock is going to be Microsoft and the time frame is going to be on the 4-hour chart. Now remember, the average true range measures the volatility of the market and not the direction of the trend. So this means that a market could be trending higher or lower while the volatility is actually decreasing, or vice versa. How can you use the average true range to find potential breakouts before they happen? So first, you want to look for periods where the volatility is at a low point, usually on a higher time frame chart. So this low volatility is going to show that a change is more than likely going to happen. It's a sign that the volatility is likely to increase pretty soon. The next thing is you want to identify the range that forms during the low volume period. This trading range is going to be very important because this is where the market is going to consolidate before making that breakout. So this is usually going to be a support or resistance level. The last thing is to go ahead and trade that breakout of that range. When the market does start to break out of the trading range in either direction, that's when you're going to take the trade and capitalize on the potential explosive move. You're going to start to see that volatility increase and the average true range start to move upwards. The Chaikin volatility indicator is a tool that you can use to find directional trends in ranges and potential market tops and bottoms, basically trend reversals. Let's take a look at Microsoft as our sample stock, looking at the 4-hour time frame. It's all about the range between high and low prices, understanding volatility as expansion of this range. To signal for a bullish reversal or a market bottom, think about a downtrend. When the Chaikin volatility indicator suddenly spikes after a low period, be on the lookout for a potential bullish reversal. For a bearish reversal or market top, think about an uptrend. If the Chaikin volatility indicator starts to gradually decrease over time, then keep your eyes open. This can hint at a potential bearish reversal. Now, lastly, let's look at the volume indicators. Volume indicators are important in trading because they can give you a look into the strength and the direction of market trends, market tops, market bottoms, and also breakouts. Now, one of the primary benefits of using volume indicators is that they can help you confirm price movements. If a price trend is also showing increasing volume, that definitely suggests that that trend is more reliable and likely to continue. But on the other hand, if you see a price trending in a certain direction and it lacks volume, that may not be considered reliable. So examples of volume indicators are going to be volume bars, on balance volume, OBV, the volume weighted average price, also known as the VWAP, and the accumulation / distribution, or the AD line. OBV is definitely going to be the most popular of the volume indicators because that's going to help you identify buying and selling pressure in the market. Now, to use volume indicators, you're going to want to look for high trading volumes when there's a significant change in price to confirm the strength of that trend. First of all, let's talk about the volume bars. Okay, so the most classic volume indicator is literally displayed right at the bottom of your chart, and you're going to see them in a variety of different bars. Comparing volume bars to those that came before it and also the next one, that can help you assess their significance. And if you're looking for potential trend reversals, that's going to be easy to see because the volume may start to dwindle or get lower or even diverge completely from the way that the price is moving. Volume bars are going to be useful for identifying breakouts and breakdowns, also from support and resistance levels, particularly when there's a surge in volume that happens at the same time that a stock's movement is moving beyond support or resistance levels. So that's something that you want to look at with those volume bars. Let's look at the on balance volume indicator, or the OBV. The OBV indicator is going to be a tool that you can use to track the total volume of that asset, and it's also going to take into account whether or not the price is going up or down. The first thing you want to do is identify the trend using that 4-hour chart, and we talked about that using the trend following indicators. Then you're going to look for a divergence between the price and the OBV indicator. The OBV indicator is going to increase when the volume is high, when the price is going up, and it's going to decrease on high volume, down, or bearish. So for example, if the OBV value is getting higher and the price keeps falling, that's going to suggest strong buying pressure that may cause a reversal in that downtrend. On the other hand, if the OBV value is going down and the price is increasing, then that could indicate strong selling pressure, which may cause a trigger for a bearish reversal in that uptrend. All right, let's look at the volume weighted average price, more popularly known as the VWAP, okay, that WAP. The VWAP indicator calculates the average price of an asset based on trading volume in a specific period of time. So let's just kind of look at an example trade using the VWAP. Okay, we're going to be using the stock Apple, and the time frame is going to be on the 15-minute chart. The default settings didn't work the best for me. I usually have the offset set to 7. Let's say that you wanted to use the VWAP for a short-term day trade. You can think about this as a support or resistance level. So when the price is above the VWAP, then that could mean that the stock is in an uptrend and it may start to use that VWAP as a kind of support, like a safety net. But on the flip side, if the price is moving below the VWAP, then that could suggest that the stock is in a downtrend and it may start to use that VWAP as a resistance level. Here are the steps to use the VWAP. Just taking a look at this 15-minute chart on the stock that you're looking at, keep an eye for the price to pull back to that VWAP. If the price bounces off of that VWAP, then this could be a signal to enter the trade. Now, on the other hand, if the price is trading below the VWAP, it comes up, has a little rip, and bounces back down off of that as a retracement, then that could be a sign to go short or take bearish positions. Before we finish this video, I just want to go over a few different example strategies on how to make the most of all 4 categories of trading indicators by mixing up a few of the indicators that we talked about today. This is for moving averages and the relative strength index, or RSI. So combining the trend indicator moving averages with the momentum indicator RSI can help you identify potential entry and exit points. So a good entry point for a bullish position would be when the price crosses above the moving average, and also when the RSI crosses above the center line, the 50 level. Now on the opposite, a good entry point for a bearish position would be when the price crosses below the moving average, showing that we're in a bearish downtrend, and also when the RSI crosses below the center line, 50 level. So using the Bollinger Bands as a volatility indicator and the MACD as a momentum indicator, you can identify potential trend reversals. A good signal for a bullish trend reversal would be when the price touches the lower Bollinger Band. So this could show that the asset is oversold, and it could be due for a price rebound in an upward direction. Also, when the MACD shows a bullish divergence, or when you see a bullish histogram crossovers. And a good signal for a bearish trend reversal is going to happen when the price touches the upper Bollinger Band, and also when the MACD shows a bearish divergence or histogram crossover. Combining the trend indicator Ichimoku cloud and the volatility indicator average true range can give you a good view of the market. Bullish trend would be shown when the price is above the Ichimoku cloud, using that lagging span. When the Chikou span is above the price and also above the clouds, then this is usually a bullish signal. Also, when the average true range is increasing. Bear trend would be when the price is below the Ichimoku cloud, and also when the Chikou span is below the price and below the cloud. So this usually shows a bearish trend when the average true range is increasing here, showing an increase in volatility. The moving averages and volume bars. Using moving averages as a trend indicator with the volume bars as a volume indicator can help confirm market trends. So a bullish trend could be signaled when our short-term moving average crosses above our long-term moving average, showing that upward trend reversal. And then also when we see increased volume bars during that bullish crossover. Now, a bearish trend could be shown when the short-term moving average crosses below the longer term moving average, and also when we see increased volume during that crossover. So these are just examples of trades, and you should always do your own research and always use risk management when you're trading. And actually, check out this video on the triple screen trading method for the best ways to use different indicators in different time periods to make those trades. So make sure you check that video out.